This is one of these cases where I complete or try to complete, perhaps badly, one of these interviews, one of these cases you get from the interviews. I call them interview cases. I don't know what to really call them. I'm going to explain. I've reorganized some of my cases so perhaps you can find them a little differently and a little better. I'll talk about this case and what's interesting and why I'm exactly doing this case and what some of the horrible things about this case are, because there's like so many others. You've got to understand they're just really simplistically and badly written, and that causes some of the difficulty, at least for me, and some of the confusion. Well, since I'm continuing, there was a little break. My editing is not so good, okay? This case we did for a group in a university. I'm not going to say which university, they might get pissed at me, but they're wonderful. They're absolutely wonderful. The enthusiasm and the number of people came on their day off, which was a kind of a Friday, plus they all came, a lot of them at least, came back on a Saturday. I was so honored, and we tried, and we had some good discussions. So sorry about the advertisement. If your university, I love to come to your university, and I'm cheaper than all these other whatever training the street or all these kind of people. I very much cheaper. Let me put it that way. So if you're at a university and have some kind of thing where you want to arrange a little session, I just have fun with it. Now, if you ask for this Google Drive that I give away, okay, in chapter 1, I give you these chapters, and in chapter 1, the very, very first little thing is interview cases. Now, I've changed them. I have a number of cases that I've completed, and there's some mini cases, there's some bad modeling, I guess, cases. These are the ones I've completed. There are some titles of some cases, some toll road cases. I don't know, some kind of soul. This one didn't really have any instructions. This one had some instructions. It was from, I guess, PwC or something. So I've got these cases that are completed. Don't worry, there are about 150 cases here. There are a number of cases that are completed by other people, some of them not badly. You can just kind of take a look at how people have attempted to do these cases, and they're for all sorts of different industries. And I've put some cases that I think are really interesting. I've separated those, and those have some valuation issues, and I've generally, I think, completed those. They've got perhaps some refinancing or some things that are a little bit trickier than a really simple case. And then I put some simple cases here, and whatever, one was from a recruiter, and sometimes they gave you the inputs. So if you're just starting, you might really want to look at some of those kind of really simple cases. And then I've got some cases, because in this case we'll look at different operational characteristics of batteries, trains, hospitals, renewable natural gas, waste to energy, those kind of cases. Okay, so because these people were really nice, that's what they gave us. Now, okay, let's open this case, and let's pretend now what I did was really a mess. They still were nice to me. I thought I was picking an easy case, so I went to these. I'm on the wrong thing here. I went to these cases and I said, where's the non-completed cases? I said, look at all these cases I haven't done yet. Oh, I got to do some of this ones. And I think, this looks okay. Let's just look at this one. So this is the case you can find. I have no idea who this company is. I have no idea who gave me this case. And they started the case. Let's just read it real carefully. If you're unsure of something, don't waste time. It's a high-level financial model. Okay, don't make the formulas overcome. Good for them. We're looking for your understanding of solar projects, project financing, which I have some comments on, financial model complex rather than Excel. Good for them. Now, my friend Hetty, I asked her, she's going to put this whole thing in AI and see if AI can do the whole thing. The case study, if we read it first, it says 20 megawatt AC, that's alternating current. So in this project, what turned out to be, it had a lot of focus on solar and whether you really understand solar. And I really wanted to spend more time on the valuation, the debt structuring, and the debt sizing. But they said 20 AC, and they immediately say a 20-year PPA. You think, I'm going to put capacity in. I'm going to put a flag in. With an investment-grade utility good, that means it's a safe off-taker. We should understand what an off-taker. I just had a wonderful 2-hour kind of class with only 1 hour of Excel in the whole thing. 1% escalator. These escalators that don't vary with inflation are kind of idiotic conceptually, but we'll go with it. And if you kind of have me come, I'm going to talk. And then I use the term financial close. They said they have a final notice to proceed. So we're going to value this project at that final notice to proceed. They haven't started constructing yet. Equity interest will be sold to a private equity investment company. I have to admit, when I read these things, I get very nervous. I'm not going to ever take an interview. I'm about to die. I'm not going to do any of this crap. But I still get nervous. So I kind of read over things. That's kind of key. Sold to a private equity. And reading this stuff slowly is hard to do. The project will be able to achieve this financial notice to proceed. Everybody used different little terms for financial close or whatever. They call it FID, financial investment decision, but that's nothing. Construction cycle is expected to exactly 1 year, further take. Now, when you see that, I'm not sure if you should make the models flexible. In our session, we made the model so it could last longer. The company intends to design a system with AC to DC overbuild. Now that's 1.3. So if they say 20 AC, AC is on the bottom and DC is more than AC. And if you haven't ever seen a solar project kind of just getting thrown up these things could be a little tricky. First year generation, the reason they say first year generation is we'll have some degradation. What's happening up here to my brain? It goes down. Shit. And that degradation, they said it's this much per year. Now, the way people typically compute a yield, you notice they still have megawatt hours. You take the megawatt hours, you divide it by megawatts, but you don't use megawatt AC, you use megawatt DC, and that gives you something called the yield, which is just the number of hours you really run. This thing, megawatts divided by megawatt hours divided by megawatts gives you hours. Independent engineer has the 99% has 90 is, I didn't have to read that. I didn't even read that. Okay. The market indicates it'll have a longer useful life than 20 years. So immediately you say, I've got to make the timeline different for the PPA. The PPA, there will be 50 hours. Why do they say 100? They say 50, and 50 times 5. 5 times 2 is 10, which 50 times 20 megawatts gives you 1,000 megawatts of uncompensated curtailment. So this is really tricky. If it's above 50 hours, it's compensated. If they're 20 hours, 30 hours, so you can put some of that stuff in. You could put 50 hours to be conservative, I suppose. And then we've got degradation. That's a typical kind of percentage, and we need an index. And the degradation is going to decline over time. They have O&M costs. Notice how they switched from MW to KW. And this is an example of a horribly written, and you should be, this is KW per year, you idiots. You're supposed to put Y in there. And they have it escalating differently than the project. The PPA, they don't have any escalation. Yeah, they have 1% escalation in the PPA. Random, idiotic kind of thing to do. And then they have WP. They have KWP, WP. This one, let's multiply by 1,000. This, let's multiply by 1,000,000 and get everything in MWP. And they say, this is another tricky one, that the writing is just so horrible. Basically, the way I read this will be spread evenly 10 to 19 over 9 years, assume that the replacement are in the same period as the reserve. So the replacement, assume that the replacements are incurred. I think I got that wrong. In the same period as, so we're going to spread this over 9 years. I did that incorrectly. Oh my God, typical. The acreage of this project is 6 per MW, but we have 20 MWDC, not AC. Oh my God. And the acre leases out at 130, and then we have some other operating expenses that just escalate, and that's an annual escalation, and I better have gotten that right. The project is required to post security with a counterparty for $4 million. It's very confusing. They have to get $4 million kind of as that. They have to have a credit card for me. That for me is like a letter of credit. They have a credit card, and that credit card will have a 2% cost on it. And if something goes wrong, and the PPA utility company says, "You screwed up, you assholes," then this $4 million will be paid, but they don't have to pay it out. They just have a credit card that pays it out. And after the project is, the PPA is finished, there'll be something called a merchant price, which is a unregulated price for 40 USD, and there's no inflation in there. And then they put all these costs, which is kind of reasonable. This is like 800 per kW, 850 per kW, or whatever per megawatt. And then which is a very reasonable cost for the US, I think. And then they have development costs. These are the costs that these people, whoever this name is, Edvin, whatever it is, that's how much they've paid. And we multiply that by the, a million to get to megawatts. And then they have some taxes. And if you're not in the US, you don't care about this, but it forces you to do a little timing. There's a investment tax credit. Let me see. It assumes 95% eligible and 5% ineligible, and they receive the 15-year straight line for the 5%. 95% gets this. I have to revise that. 30% investment tax credit, depreciation basis reduction in half of the ITC. So if you've taken 30% tax credit. That means you get money immediately. That's the way to think about it. 21, which is the U.S. federal tax rate, not the state tax rate. If it's in California, I don't understand why they don't pay state taxes and why it's not taxable in California, but we'll go with that. And then this is the interesting one. There's somebody else, this private equity is going to buy that, and they want to get an after-tax IRR, and they haven't talked about debt yet, so I assume they're talking about after-tax project IRR. The buyer is tax sufficient, so they're going to use the tax it. There's a transaction cost which is borne by the buyer, not the seller, but I don't know. If it's borne by the buyer and they need 8%, they're going to pay less by 1 million than for the thing. And then they ask you some questions. What's the annual? They ask you to make an annual model. I made it more complex, but then for some reason they ask for a monthly schedule. And they said based on the project economics and equity investors' target criteria, how much can they afford to pay? So you're supposed to do a valuation. That's part of this case that I liked. Based on the total investment and uses of funds, development fee, how much would they, based on the total investment amount and the pre-development fee, that was up there, and uses of funds, what is the development fee that the buyer could afford to pay? Now, this is a little bit tricky how we're going to put it in terms of a development fee. A development fee basically is we're going to figure out the value to get 8%, and then we're going to figure out the total cost of the project, and we can assume that premium of the value you paid over and above the cost of the project goes to the developer. It's a little iffy. But these people are a developer, and that's kind of what they want, because the private equity company, we assume, is going to do the financing over this first year, run 3 sensitivities. That's nice. We have to do some sensitivity. Assuming the company owns 10%, owns 10 development assets, which specific outputs would you require to use to make a corporate forecast? We just care about cash flow, I assume. And then they have this craziness. I don't know. What in the hell? When you read this stuff, assume monthly construction, okay, they told us. Loan to value, 95 goddamn percent with equity invested before debt. Oh, shit. Interest rate of 2% and commitment fee of 5%. Interest rate of 2%? Do they mean upfront fee of 2%? Interest rate of 2%? No, they have origination fee, upfront fee of 1%. What in the hell are they talking about? 95% loan to capital and 2% interest rate, and you're supposed to get 8% on the project IRR. That would give you an equity IRR of something astronomical. But that's what private equity maybe wants. And that shows you these people have no clue about debt. They don't even tell you. The first thing I want to see, what's the DSCR? How do we repay the debt? None of that in here. Assuming that how does the construction financing impact, assuming the buy? So that says, okay, now we're going to change the whole game and say that by our IRR is 8%, and we're going to do this case. So now what I did, construction finance, what's the uplift to equity investor, and how much more can they do to get 8%? That's the same as this question. Oh my God. Okay, that's where I go crazy. So some of these detailed solar things, it's pretty good because it's pretty detailed. It includes a tail. There's some tax things that were a little bit tricky. Now, there is, if they gave this test and said, complete it in 3 hours. That's just bullshit. I don't know what you would do if you had to, if you basically have an impossible test and you're supposed to complete it. Do you go home? Do you just start completing some of the stuff you know really, really fast and try to make it look good? So this is their crazy debt stuff. They don't distinguish the 8% versus project or equity IRR, no inflation on the merchant prices. They ask for monthly construction and then bizarrely annual. We're going to, just so you get this right, we're going to do monthly and then semi-annual, no debt tenor. Okay, but it does have some good timelines, and we're going to make it have better debt structure. Now, when we did this, I suggested here's in this, if you look at this folder that I give you, okay, there are a whole bunch. If you keep going up. Yeah, keep going up here. Number one, these weekend sessions files, I should change that to advanced. Project finance models and exercises, there's a whole bunch of stuff underneath, including fast models and advanced models, models from others, circular reference issues. The big one is this featured models, and I don't know how many solar models I have. I have a bunch of solar models, for example. And just taking a look at those models might be good because I steal ideas and I say to people, oh, and it's not totally false. I'm not drinking right now, but if I have a little glass of wine and I look at a big financial model and try to steal ideas and look what's shit in this model and what's good, it's a great evening compared to some of the other evenings I have. Now, the next thing I did is I'm not going to waste a whole lot of time on all these operational things. I'm just going to try to explain them. And I think it's absolutely key to set up the inputs in a good and well-structured way and an organized way. And if you don't do that, you don't have a chance. And sometimes these idiots, they give you the inputs themselves and they put things all over themselves. I've seen an AI generated thing that was so horrible the way they put the inputs in. They thought it was all fancy, but it wasn't. It was slop. And you set up a little a scenario number that's crucial. Now I did a little conditional formatting. I'm not even going to bother to tell you this. You just make this equal this, and you go to home and you go to conditional formatting. I don't want to do it. And you go to new rule. You select the whole area first, and then you use a formula, and you make sure that this number here, and you take the column off of it, so and then you make that equals here, but you have had to shade the whole area beforehand what's going to be shown, and you can get nice and fancy. Don't waste time on that, so that's why. And you're not even supposed to put one of these little spinner boxes in here, but with my wonderful people who I worked with, we did. And then so now I said, okay, well, let's make a delay case. Let's make this thing called P90 is reducing it's a downside case. So you take the P50, you push it down, and you push it down until there's 90% times you're above 50/50s, 50 up, 50 down. Push it down, downside case, 90% above. That's how you explain what it is. Maybe we'll just have the life only equal to the PPA. So because that merchant stuff is too speculative, maybe we can put some higher costs in there, that higher cost of the replacement. Maybe we have a higher transmission constraint, and maybe we have a higher capex. Now, I'll have to admit something here. Maybe it's because my mind is degrading, but I had to read this a couple of times to kind of understand. So first they said, except for this one, we have 12 months of construction. And remember, this was the life. And each time you do something like this, you use E date. You put the original date in. I used eDate. You could use EO month. And if some fancy goddamn Excel person is going to say, oh, no, use EO month, screw it. Use one or the other. It doesn't really matter. Then I put this as the day after. This is basically the day after you're dead. Okay? And this is the day after the PPA is finished. Each time you start with a date, and of course, if it's year, you have to put 12. And some people will get obsessed by putting 12 months and go down and make a range name and put the number of months in a year as 12. Oh, that's miraculous, because it's illegal, really, to put a number and a thing together. But the main thing I emphasize is I'm pressing F2 when I do this. And if you can press F2, and then you use the index, and notice I have some extra index, and you can put as many scenarios, and you take an area in the index and you tie it to that scenario number. So it's absolutely crucial to set up. This is not my ideas. Now, the other thing we did was said, okay, there's going to be 12 months in the period, and in the construction period, and there's going to be 6 months, meaning 2 periods per year in the operation period. And then we start putting in the capacities. And my suggestion here, and I would do it differently every time. So when somebody gives you some bureaucratic instructions, you say, screw you. You're supposed to do these things and think. And they say, oh no, we got to put this in this sheet, not in that sheet. Okay, they gave you this and 1.3, remember, so that DC, which I called MWP to be fancy, because that's what people call it, and MWAC. They gave you the 20, they gave you the 1.3, put this in the input file, and then they gave you the initial period first year output as MWH. And then you put MWH yield, but it should say annual yield, because if you have a 6-month period, you're going to have to divide this by 2, and that's before you consider degradation. Degradation is going to be like the opposite of inflation. Inflation goes up, degradation goes down. Availability, that's okay. Curtailment, how many hours? I should put 50 hours. And then, except in one case where I said, 300 hours. Or we could put 300 hours in all of these. In this case, after the PPA is finished, there are going to be some exposure to hours. And if you're really smart, you try to act smart. Let's talk about curtailment hours. And that is the big issue. But I'm not going to spend too much time. And remember, they gave you the USD per watt. I put everything in megawatts, so we don't have to worry about multiplying and dividing by 1,000. These are all the inputs. And in one of the inputs, I put higher CapEx over here. And then they had the 70,000 of development cost. And we can see how much. This is the amount they spent on doing all their stuff to get to this point. And then they want millions for that. Well, I understand, because they're going to make 20 different projects. They're all going to fail, and 1 out of 20 or 1 out of 10 is going to survive. So they want to sell this thing to a private equity and make their enormous amount of money. And then you get the total amount per MWP. And then I said, well, what's the total project cost? And instead of calling this capital expenditure, I call it project cost. And then we put it in USD. By the way, I have this generic macros open, and there was one wonderful person in the class who said, I did the class everything right. And I didn't. And when you go through, I spelled it wrong. When you do this, come on. Okay. Why can't? Am I opening the right one? No. Oh, God. Okay, I'm going to do it one more time and then give up. Why didn't I open? I can't even. What am I doing? What is going on? Damn, I'm going to pause the video. Well, you go, and finally I opened this stupid thing. You go to my website, you download it from the home page. There's a little blue button. You click, you enable, you make sure that it isn't unblocked. You know how stupid old Microsoft blocks everything now. And then you unblock it, and then you click on this little thing. And then after you click on this little thing, all of these little formatting things happen. Some wonderful person said, I did all the case right, and they said it wasn't formatted beautifully enough, cleanly enough, or something. Then remember they had the PPA price. So the general idea here, if you have this, by the way, Control Alt C, and we're just going to color, and you can change the colors and all that. Why did this not color? Just hang on 1 second. I had to have B instead of A here. Oh my gosh. I think I just did it with A a little while ago. So it's very flexible. You can do all this crap. Okay, so we put first how the plant operates, then we put CapEx, revenues, and OpEx. And all those revenues, they had O&M, they had some other expense, and we have to put per year. This O&M, I put MWY. Remember, I complained about that. And then I put the escalation rates nearby, although these two had the same escalation rate. And then they gave you 6 per MW. So then you take that 6 per MW, and you're not afraid to do a little bit of calculation in this page. If they give you shit about that, I don't know what to say. Tell them to go to hell. And then that was our cost per megawatt, and then well, this was the megawatts, this is our cost, so this is our USD. So we get things in USD, and Shift Control D, that's, oh shoot, it doesn't work because of the video, okay, I can't do that. And then in the inverter cost, they said it goes through year 19, it starts through year 10. I did all this calculation, and I realized I did it a little bit incorrectly. And I had one where we have a higher inverter cost, and maybe you want to start at a different period, end at a different period, and show how you're doing this. Essentially, you take that total cost per MW, multiply it, and do all of your calculations here. And then they had this security thing. And then they had some income tax rate. And you know what I realized I didn't do? We should put a percent LGELI for ITC. And I was horrible. I didn't put that 95% in. And I just did it wrong. That's very good that we're doing this, because you would put the 95% here. You can press Shift Control R if you have generic macros, then you press Control D, and then if you want to really color the sheet really fast, which you would never do, you'd color it kind of at the end so you don't get criticized. And you could say that if they say their coloring is not good enough, I don't know what to say. Then I make the debt tenor. Maybe we should make it 17 years, because it should be less than, we'll say they don't, that merchant price on a solar is such a speculative kind of thing. And then we start repaying at the COD. So if you go up here, I press Control square bracket, and then I press F5 to go back and get it. And then the end of the repayment would give you this period. And then I said they didn't give you a DSCR. I put a DSCR 1.2. It's really 1.2 on P90 and solar, but blah, blah, blah. I put a much more realistic interest rate. I put a maximum debt to capital ratio. Okay. Oh, that worked this time with the little square brackets. You have to show you're cool, don't you? And then we put some valuation assumptions. And I should right here have added transaction fees for buyer. And I think that was 1 million. Do you remember that? 1, 1, 2, 3, 1, 2, 3. Now I do this. You don't have to, but I swear you're going to think, oh, I'm too good. I'm going to do it in millions. And then you're going to have to divide by a million, multiply a million. I forgot. Did I put a million here? Did I put 1,000 here? Oh man, I worked on a nuclear plant for a long, long time. I'm not probably supposed to say that, but I'm not working for them anymore. And that's why I need to find other people who might want me one day. Uh, they did everything. It was 33 billion for the whole project, and they did everything in USD and nothing in thousands. And they did everything in kilowatt hours, nothing. And down here, they put. Remember, they put an upfront. Now, when they do this upfront fee, you know almost that you're going to have a circular reference. So we'll put that one in. Control D. Whoops. And then we'll put in the commitment fee. It's just amazing. They put in, a commitment fee. We better put a commitment fee in, but then they didn't put a debt tenor. What, 0.5%? I'm not using their 2%. If they want to argue the interest rate's really going to be 2%, okay, well, I suppose we'll do a sensitivity analysis on it. 2%, okay? Those things are going to cause a circular reference because they affect the cost of the project, and which is they get added to the cost of the project, and when they get added to the cost of the project, the debt goes up, and if the debt goes up, the fee goes up, and you got the blah 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 blah. Okay, and then I think, to make things a little more interesting, let's put up here a sale IRR for new buyer, because you know what these private equity people do, they don't like to keep the project. They want to resell it when the risk goes down. And then we'll put a sale date in, and then we'll do the same thing up here to show the upsides and to show something a little more complicated, and we'll put a refinancing date. So let's do the same thing. The sale date here, let's make the sale date, of course, let's make the sale date CO2 plus 2. How about, and we can put sell flag. Now, do you notice what I'm doing? I suddenly got a little lazy. I kind of, and I think, oh damn, and then we can either sell it, and then let's up here, down there I put some sensitivity discussion. We can do this at a different date. Maybe we'll refinance at E date of the COD 36. I don't know. Okay. And when we refinance, we can put a refinance flag, and we can put that. And I guess if you really want to, I'm going to format the same thing, and I should spell it right. I did. And let's put true here and false here. That's some of they didn't ask for that, but I'm trying to make this whole thing a little more interesting, so we cover some of the issues that you really might run into if this was a private equity. Now, after you do the input S, these are all kind of things we can do here. To illustrate things, I'm on the taxes. I'm going to make one other tax assumption. So I press Shift Spacebar, Shift Control Plus. Please don't waste time with the stupid damn paintbrush. I've never used the paintbrush, I think. I can't remember. Maybe I have a long time ago. Let's put flag for SL depreciation. Okay? So because I don't want to make this too US oriented and all that. Okay, and good. And let's put true here. Okay? So we can either use all this fancy depreciation and press Control D or not. the depreciation rate they gave changed over time. So unlike all of these other inputs, and that's generally in real models, almost all inputs vary with time. In cases that you get for these interviews, almost none of them vary by time. Okay, but this, when you look at other people's models, this is kind of what you're going to see. Now, the first thing we did, and I'm just going to kind of try to explain what we did. The first thing you do is you get how many months do you have, or how many periods, if you want to call it that, do you have before the COD. This is such a central key variable because the whole model is split. What do you do when you need to borrow money? And what do you need to do when you repay the money? It's absolutely essential. And then I use the sequence function at comma, and then I went all the way to 150. And that means at the very end, there's hardly anything there. And then the next thing I do is put a little if statement. If it's upstairs and you use the ones and the zeros, and I'm going through this quickly. I'm sorry to be review, but 1 is true, 0 is false, true is true, 0 is false. In the if statement, you just say if it's true, then we have 1 month per period, otherwise not. And then you take that period and take 12 divided by that. You could put that as a kind of a range name. And then you start the model 1 month, 1 day before it. Before the start date, remember that start date, control square bracket to find it, F5 to go back. And then you can use this number of months in the period. So once you hit the COD, once you get past the 12, do you see what happens? This could be 12. We could have done the whole thing and hopefully it would have all worked. If this thing would have been 12, remember you only change the inputs. And if this was 12, then we would switch from a monthly model to a annual model. So we go here, and that's when we're retired, I guess. Okay, here this was month by month by month, and this is year by year by year. Being able to go through and do not really, really complicated timelines, but relatively complicated timelines is so essential. I can't even tell you. And then finally, we put an operating flag. I almost want to put this this gets used so much. This, because we're going to multiply the capacity by this. And then we have the PPA flag. And when you have this, I put the start date and the end date. And this, remember, it's the day after you die and all that stuff. This is the start date, the end date. I am thinking about dying a lot these days. And then what you can do is you can put equal and you can go up to this one. Notice everything is at the beginning of the year. And I press F4 a couple of times, so we lock it. And if this is greater than or equal to this, and then you press F4 3 times. And also this number, F4 twice, is less than, not less than or equal, but less than this, and F4. And then you press enter, you get false, shift control B. If you have generic macros, shift control R, and you do a little sum. And when I do a sum, I go all the way to the end, so these auditors don't give me shit about, you didn't do the sum long enough. I don't know why that happens so much in my nuclear plant. So then we have our MW AC, MWP, how many hours. This yield is, we got to be really careful. This yield is, this is the annual yield. I've got to be so careful because when we put the annual yield in here, we've got to divide it by 12 to get it by month. And you can see that this months to make up a year is an enormously important thing to do. Getting the timeline is so important. If you're going in an interview, I would say practice the damn timelines, different timelines. Go look at these different cases. Be able to do these in minutes. Complicated timelines. And then I put a degradation rate. Now, when we put a degradation rate I'm going to do it really fast. You can't just divide it by 12 if it's monthly. And you want to, you have to, because it compounds up to a year, you have to take 1 plus the annual rate raised to the 1/12th or 1/6 power, 1/2 power, 1/2 power. And then you figure out your index. And when you do an index, use the famous operating flag. So if I multiply this 1 times 1 plus this and multiply inside the bracket, not outside the bracket, then it doesn't start my index till there. And my index is going up, so I'm going to have to divide by the index, not multiply by the index. Gives you a tiny little different number, but I think that's the right way to do it. Then we get our generation after the degradation. So our generation before the degradation was our yield times our DC, because that's how we defined this a yield, and which was in hours. And then we divide it. So you notice the amount is lower because of the degradation. Then we put this availability, and then we lose it because of the availability. Then we put the constrained hours, but then we put a maximum constrained hours. And then we have to do something a little more complicated, because this thing works just during the construction period, the PPA period. And you just have constraints. If I go up here and change this to the case where we have higher transmission constraint and we have more hours, we've only got 50 hours, so we take the minimum of these two for the PPA period. But if it's after the PPA period, we do this. And I'm afraid that I hate to show you this, because after the PPA period, and we had a PPA flag up there, then we get this, and then we can figure out what the loss, we multiply that, and they told us kind of we should use the, look at this, I almost ran out. What you should be able to do is show almost, when you press F2, everything will come out. And when goddamn AI does this, they fuck it up. Sorry, we screw it up really, really badly. So we get the total generation after the constrained hours. And then we can put the PPA generation in and the merchant generation. And that's a function of those two flags. Then we put in the PPA revenues. And I tried to do this a little more quickly, that we put every time they're going to have some kind of escalation rate, and we put an escalation index. We do that almost exactly like the degradation. And then we finally are really transparent. We see what the generation is up here, and we multiply the generation times the escalated revenues, and we get the revenues. And the merchant one, they didn't say escalates, which gives you a crazy result, meaning that right here, the PPA revenues price was 89, and the merchant is, I guess, less than half of that. And so the revenues suddenly have a very, very steep decline. And we go through all these horrible revenue expenses, and just remember that these were mainly annual expenses, and so we have to divide them by 12. We put the leases in, we get them all together, and then we put all the ones that inflate at that same 2% rate, which, where did I put? Oh, I put the 2% rate over here and used our little 1 plus blah, blah, blah. And then we get our inflation index, and we get our inflated rates. And then we had that security thing, and it was, did I do that wrong? Because just a minute, our security was, we need 80,000 in them, but remember I did that right, because I hope I divided it by 2, and then I multiplied it somewhere by the 2% rate. I think, I put that that's already in there. That's already in the inputs. And then I put this inverter replacement. I thought the inverters were being replaced in year 19, and we were just putting a reserve account for that. I misread that, because the inverter replacement amount is actually exactly the same as this one. So what I can do is, can I go down here and cheat? I'm just cheating. This is really bad. But this is the actual inverter replacement. Now, normally I would set up something called a maintenance reserve account, and I thought they had that in there. They didn't, luckily. So that would say you put money aside, and you put, because you know you're going to have it in the future, and then you replace them. But I was wrong. I was really wrong about that, and I'm sorry for people in the class, by the way. I put the graph up here, and then because I wanted to make a graph, and I think, did I use the NA function here? I didn't use the NA function. I just want to show you something. If you want to make a graph, you put if it's the operating period. The EBITDA only occurs in the operating period. Then take the date. Otherwise, take NA and open and close bracket. And then once you have that, you can select this, select 2, shift control right arrow a couple of times, press F11. And then I did it wrong just a minute because, oh, very good, I made a mistake as usual. You press shift control 3 because we need these dates in a date format. And then you take this and you press F11 and you get the kind of the just over. Look at how the, oh my God, the EBITDA went down to be below zero. So you wouldn't really have that. You'd have to cancel the project. Okay, interesting. What did I change to do that? Well, I'm not going to worry about that. Then I put the CapEx in. Now, the CapEx, they said, was spent evenly. And I think they talked a little bit about the fees occurring in the last month. Maybe that's why you wanted to do that. So I just took the number of months we had in construction. And if we change this and put a construction delay, then you notice that just gets spread over a longer period. Okay, this thing's called the S curve and would often go in to this input S, and you could get a little fancier with that. But very often they wouldn't bother asking you about that. Okay? And then you have the CapEx per period. This was the total cost, remember, from all that stuff together. And then you do the big one. Free cash flow without, and they didn't put, thankfully, they didn't put any accounts receivable, accounts payable. It's EBITDA minus CapEx minus working capital change minus some other stuff. You learn that in finance. And when you compute this IRR, because you've got a monthly and semi-annual, you put XIRR, and you really practice that over so that you're so fast at doing the XIRR. I use the end dates, and we'll see why in a minute. And that's kind of interesting. It's a little bit above the 8%. But then they said do it after tax. Well, yes, let's stop here. If we just wanted to get a valuation of this project, and this is kind of, I think, what they're asking, I put this, let's get this 8% from the inputs. That was kind of bad what I do. Now, when I use this, and if you don't use generic macros, I'm sorry. And if you maybe have AI tell you what to do, maybe they'll do it. What you could do here, and then I did a little bit of a bad thing, and I think, yes, I'm going to review the valuation. Let's make a valuation here from pre-tax IRR. The reason I'm doing that is because very often you'll have this, and this is USD. Oops, let's just copy it this time. If we said we've started with an 8% rate, then look at me, I'm not finishing up a sentence. If we use XNPV, and that uses an annual rate, and we take all of this data here, all of the cash flows, and then we take the end dates like we did before. That's the value. And so if the value of the project is this much above all of the operating expenses and capex. So let's pretend that the development fee was paid right at the first the beginning, at the notice to proceed or whatever. So I'm just going to make the development fee this NPV, and I'm going to cheat. This is really bad, but I'm going to take this and multiply it by this thing. Well, the period equals 1. That's really bad. Okay, but that gives you 1, and then the cash flow to the private equity. It makes me throw up because these private equity people have destroyed my goddamn life. Okay. Oh, you have to stay at a hotel that costs $30 euros a night in Europe. Oh my God. Well, not that, but they make you stay at the cheapest one, which is fine. I like the cheaper hotels a hell of a lot better anyway. I want to stay with those snobs all the time. So this is the amount we have to pay them, and so the final IRR to the equity to PE on a pre-tax method is this percent. Okay. XIRR, of course. And we take, so this thing should be 8%. Oh, please be 8%. And that's kind of what it is 8%. Oh, we got it. That's the idea. That's kind of the valuation idea. Now, I said that let's put up here, let's make another little thing. Okay, I don't know. I'll put valuation with changing rate, because what's really happening is that the PE company is going to buy it right at the notice to proceed, but there are going to be construction risks. And after the plant is finished, the construction is gone. That's my marriage, and the development fee is your dating period. You make this promise at the financial close, I'm going to love you forever, and make those stupid contracts. And then you get to the COD. Maybe you can tell I've had problems. You get to the COD, and then you say, you move in together. And then is it going to work? That means, are these estimates all going to be correct about the operations? Probably not. If it doesn't work, your IRR is a lot worse. And then you go a few years after the COD and you've resolved all the risks. You notice you're resolving the risk step by step by step. And these people I worked with on the course were wonderful. They listened to my crap a lot. So I tried to give them a little crap as we go through this. Now, once you have this, I put this buyer rate using a lookup function. I used XLOOKUP. Yes, let's do it. So I said XLOOKUP. Don't ever use V or whatever, HLOOKUP. Why they even have that in Excel anymore is a mystery. You put this in and you say, well, our buyer discount rate is going to depend on the dates. So you put those in first. You better press the little F4. And then you press the dates in and press F4. And then you say, well, what happens if we don't have anything? I'm going to put 0 as the rate. No, I'm going to put 8% as the rate. That's what I'm going to do. And then I'm going to put, I think I put -1. I should know that. That's why I was reluctant to do it. And what happens is the rates go down over time. And this, because of the risk going down, the rates go down. Then the next thing we do, and I don't know why I put this year here. I hope I'm not just messing up. Then we get the value of the project at the different discount rates, and the value goes up. And this is a key thing about any of this project finance. The value goes up, and you take X NPV, but you notice how you have to stop at the end dates here, and you put X NPV, and the value goes up. And I know why I put those things in. I love to kind of make a little graph of this and talk about what happens to the value, and that's why I'm doing it pre-tax, really. Because it's kind of clear. This is, and anybody who says EV to EBITDA, well, the EBITDA is this, and the EV is about the same. So the EV to EBITDA has almost the same shape. This is what happened when you hit the merchant period. The value went down. At the end of your life, like me, you're somewhere around here. Do you think I'm here or here? I don't know. You're somewhere here. And when do you want to sell the project? You want to sell it up here, and you notice how you get a step up in value when the discount rate goes down. Okay, Alt-EL to delete the graph. And then we put in the sale period, and we just make a little flag with the sale period. You say, if this is, put that as 1, and then you put the holding period, and it's the same thing, but it's less than or equal to the sale period. And then you put the cash flow for the holding period as the cash flow that you'd have to pay anyway. And I suppose I did this a little bit badly, because this cash flow should have been after the development fee, maybe, because they have to pay the development fee. Plus, you pay the NPV of the value of the project. So this, hang on, I'm just going to do it again. Let's take the holding period multiplied by how much cash you have to outflow and inflow during the holding period, plus the sale date times the value of the project at the day you sell it. Everything depends on the target IRR, which is the cost of capital. Nothing depends on the terminal value or anything else. Some people are going to give you EV to EBITDAs, and now our cash flow looks a lot different. The cash flow over the holding period looks like this. And I'm going to put this here and press a F11, and we get kind of like a regular old, whatever we call it, LBO model, or whatever you want to do that, call that. So that's our cash flow over the holding period. But, and I put some other junk here. Oh, I tried to show that the EV to EBITDA would be really low, and you couldn't do it. And screw this. I'm not going to do that. I talked about that. Okay, and I just did the cash flow to the buyer and all that stuff. So I've just kind of redone that, because I thought that was really important to do. And then we put the taxes and depreciation. Now, I think what I'm going to do here, I've already been talking for an hour. I'm going to pause the video and put some of the other tax stuff in that I got screwed up, because I'm going to screw it up anyway. So let me pause this, and I'll get back to you, and then we'll compute the after-tax IRR. Then we'll put in some of the financing, and I'll probably be talking to you for another hour. All right, to try to finish this video, let me do a couple of things. I had to turn my camera off. Let's just discuss the depreciation and the taxes and the investment tax credit and the depreciation basis. Most of the time, you'll never have to do this. So one of the things I did, I said, okay, perhaps let's add a new case. To add a new case, all you would do is insert a column. I use Shift-Control-R, and then you can press just once the whole column is selected, just press R, Control-R. And let's put that no tax incentives. Now, when I do that, I'm going to wrap the screen. And I used Alt-DIS. I used the old method. Nothing wrong with the old method, really, is there? So now if we press number 2, we're on number 2. And for some reason, I did the damn coloring again. I'll have to redo the stupid little conditional formatting. I even put something in to make sure that doesn't happen. And of course, I forgot to do it. So here's what I'm going to do. In this case, with no tax incentives, we're going to go down to the tax section. And in the base case, we'll assume, like they asked, that 95% of the property gets all these special tax. It's called the investment tax credit, and they also get the really fast tax depreciation. But if we put it to zero, then there's no tax depreciation. And then, yes, and I don't have to put this little business of apply. Yes, I do. I pressed on Control Z. Okay, let me explain how this works. So the first thing, if you have some depreciation and taxes, just start accumulating the CapEx. Now, you are eventually going to have to add, if it gets really advanced, the CapEx on the interest during construction and fees during construction. They're CapEx just like other CapEx. They're just qualified. But when we compute project IRR, we don't want those. And then now the first thing I'm going to do is say, well, how much of the tax gets our special treatment? If I put 0, then none does. And if I put back to the base case, we get it there. So right now, we have 5% of the total amount of the depreciation qualifying for all these special benefits. The first benefit, and the biggest one, is you get this thing called investment tax credit, which simply means a tax credit is different than a tax deduction. That's like money today. You can deduct that today. You can sell it to somebody in the kind of the new, whatever, not that new. You can sell it to somebody and it's just like money, but you don't get the full amount of money because I suppose there's a possibility it can be recaptured. And then we put a flag and use the flag a lot. This time, you remember how the flag works. You just would take this number equal this number, you press the F4 key, and if you have the generic macros, you press Shift-Control-B, and you don't waste your time with a silly little if statement. If you can possibly use that. Then you multiply the 30% times this amount, but this amount is the basis. It's only 95% of the property. And then at the end, we can sum this and make sure it all adds up. Now, then they have this complicated thing that some wonderful person came up to the end and said, why didn't you take the 50% deduction? What you have to do is take 50% of you take this from here. I think there's nothing wrong with kind of using prior calculations. And then you take half of that number and multiply them, and you take it during the depreciation period, and then you accumulate it. And that's like an accumulated loss. It shows up a loss on the financial statements that we're going to do at the end. And then you get the depreciation basis for the MACRS, and then you figure out the years, and the years are a big deal here. To get the years, you first just count all the periods. And once you've counted all the periods, you just keep adding up the operating switch. You just keep adding it up. So eventually when it starts operating, you get year. But this is semi-annually. So you've got 2 1s, 2 2s to get 2 1s, 2 2s, and so forth. You round it up and you divide it by 2. 1 divided by 2 is 0.5. 2 divided by 2 is 1. Round them up, you both get 1, 2, 2, 2. So then we can get the depreciation, to get the depreciation rate, we can use that little round up technique. Where in the heck am I? Blah, 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 blah. Okay, taxes and depreciation. We get the year, and once we get the year, we put the amount of depreciation in here, and I always say there are 3 functions. Lookup is why does it? We look up on this year, and then we click the entire line here. And then I've done all these tests, and I have found that this using the entire line doesn't make it go slow. Now, I did something wrong because I need to put a 0 here. If I put a 0 here, it gives me 0, and it just looks up based on this one. Now, if I copy that, I get 200%. I have to divide that lookup by if we have 12 months or 6 periods and all that, 2 months, 2 periods in a year. And then I just multiply that rate by the base, and we get our depreciation. And then to get straight line depreciation, which might be a little more interesting, we use the year again, age in years. I repeated that, and just use an and to say, well, if it's between 1 and 15, when it's 0, it's not born. And then you can get the total depreciation rate by dividing the periods, but 1 by the periods if there's no salvage, and the straight line depreciation is just the total, and we should kind of keep that just a little bit in sight, the total subject to, and you should be able to use the F2 and see what's going on. And then we add up the 2 depreciations, and we take our pre-tax cash flow that we computed before, control square bracket, F5, go back, and then we can take our EBIT. Well, EBIT is just EBITDA, which is 77, minus the depreciation. They gave us a 21% tax rate, and then we got extra credit. That's a direct credit for the ITC. So our after-tax cash flow is what we started with minus the taxes, which in some periods, when you have all that fast depreciation, they're negative. So on a present value basis, you get the benefit, and then you also get this investment tax credit, and then we can get the after-tax IRR, just like that. So our after-tax IRR is greater than our pre-tax IRR, and if we do a valuation now from the after-tax IRR, we get a much higher development fee. And that's basically what they asked us to do. So right now, we got an extra $5 million, and that if we take the NPV at 8%, X NPV at 8%, we get an extra $5 million. Now, how about this? I'm going to pause the video and redo all of our valuations. Redo all of our valuations with this, because that's really what they asked for. All right, we just had another break. Once we have the after-tax cash flow, and you just need EBIT. Remember, that's not the real taxes. That's the taxes on the EBIT, only on the operations. So the after-tax project IRR is only does not include any influence, any depreciation, anything related to the financing and things like commitment fees and interest during construction and all of that, which affect depreciation, are not related to this chair. Okay, financing. And then we do the same thing. Now this time, I put one case with no tax incentives, but let's begin with the case that has the, let's begin with the base case. And in that case, we have a lot higher project IRR. Excuse me. And if we wanted an 8% IRR, as our famous private equity company wants, then we would be willing to pay with the XNPV, again, F2 to show that, we would be willing to pay 5 million more than all that cash flow, and we can make that a development fee right up front. Now, if you made this a development fee later on, you might have to adjust the cash flows a little bit. But I'm assuming the private equity company buys it right up front. And then, again, perhaps I didn't explain it quite well enough. We're going to do another valuation. And we're going to have this famous compression in discount rates. And if somebody kind of asks you, well, these discount rates could change. If the discount rate is lower, that means the value is higher because this is the discount rate for a future buyer. And that's what we kind of want to do. We put the sale period with a little flag here. I hope you can see, you're looking at the formula. Then we put a holding period, which is less than or equal to the flag. Then we make another cash flow, which says take the first flag times and multiply it by the cash flow, and the second flag and multiply it by the NPV, and then we have the value, and we have a big value, and just like before, we get our value increasing a lot. It might be kind of interesting to see what happens in the case where we have no tax incentives. We start with a lower IRR. This is kind of interesting. We'd have to think through this. We'd start with 11% IRR, we get up to 13% because of the way the tax flows work. We actually get a better IRR. I'd almost have to check that because we're selling the project. When we finally sell the project, we still get some cash flows left. That is a surprising and unintuitive result that I don't like. Now, let's move. I'm just saying that because I want to finish this video. Now let's move to the debt sizing. And the debt sizing, now I strongly believe that the primary way we do a debt sizing is with a target debt service coverage ratio, and we use a formula. We use the formula. Let's start with EBITDA, and let's now put some taxes in temporarily. And I'm sorry, let me finish the sentence. We start with the EBITDA, we get CFADS. We do something really, really important, which is get a flag for the dates of the repayment. That's absolutely essential. We take the cash flow. For now, let's just leave the taxes out for a minute. And that's actually realistic potentially in a U.S. Transaction because of the way they structure the special purpose vehicle, as the ownership of that is separate from the ownership of the taxes. That's a little bit tricky. We put a repayment flag in, and we multiply our cash flow available for debt service by this repayment flag. Okay, and then we put in our target debt service coverage ratio, and we use the formula. So let's put this target debt service coverage ratio in just for a minute. And we keep all of the inputs for the debt structure a little bit separate. So it's a solar project. I put a fairly low DSCR. In reality, that DSCR is taken on the downside case. Do I have... Yes, I have the generic macros open.
once we put in our target debt service coverage, of course, when we take something from over on the side, we do this, then we can take our CFADS as our cash flow available for debt service divided by our debt service coverage ratio. Now, we're going to have to make an adjustment for that to get the present value of the debt service correct. But just to get this started, let's also put in our interest rate. And this time I put an annual interest rate. But I'm going to take that annual interest rate, lock it, and divide it either by 12 or by 2. I'm going to divide it by this thing. Now, you could get all the silliness and say, oh, we're supposed to use a 360-day period and count the days in the period. And you can do that, and please don't be impressed with any of that. Then up here, we're going to take the net present value at the interest rate. Now, that only works in this case if the interest rate is flat. But normally in a project such as this, and I'm going to this time use NPV, not XNPV. Why am I doing that? So we can make it flexible because we want to start. We have one case that starts a little bit later, and I'm going to realize that this NPV only covers the amount. I'm going to divide this NPV by 12, the NPV, the interest rate, by 12 and multiply by our 6 period. So that's a little more elegant. That's our interest rate during the repayment period. And then we'll use the NPV formula with that N discount rate and our, I'm going to put NPV using that discount rate and all of our target debt service. Now, let's just leave it like that for a minute. Okay, that is the amount of the debt we can afford to pay if we want to achieve a debt service coverage ratio. That formula, that NPV formula, is so essential in a test like this. There are other ways to do it. One way is to use a goal seek. You use a little goal seek and you figure out we want to make absolutely sure that our closing balance goes all the way down to 0. I think if you have one of these tests, using a little bit of mathematics is so absolutely important. Now let's get the project cost, and the project cost is going to come from below. And what that really means is we're going to have a circular reference problem. We won't have one quite yet. I'm going to go ahead and get, oh no, I didn't put our units in. I thought I had when I had a little break. And let's go up and get our capital expenditures. That was a big deal, and I probably didn't even put the underline here. Normally I would have put an underline on the CapEx. Control and the square bracket, that's the thing next to the letter P. Let's put Shift Control G maybe. Okay, so we remember that's such a big deal. But let's see if I press F5. Can I still go back? Yes. And then I press Shift Control R. And later we're going to put in all these other fees. We've got to finance all of this other stuff during construction. And if you press alternate equal, that's not related to any generic macro. Shift Control R. Let's put a little underline, Shift Control E. And we've got all of our Shift Control V for Victor, and we've got all of our total CapEx defined. We can take right now that sum gives us our total project cost, and then we can say, well, let's compute our debt to capital ratio from the total project cost. and we'll do it like that. Then the next thing we can do is say, no, 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 no. What happens if the bank says we have a maximum debt to capital? And I've seen many of these cases. When you review these cases, there are, should I say many? Definitely a few that say, well, let's take the debt to capital and let's take the debt to capital percent, multiply it by the project cost, and we'll get the debt to capital, and we'll compare this debt to this. Oh, I did it like this, didn't I? I did it much more elegantly, which is to say I put the project cost in again, and then I multiply these two together, and I get another debt to capital, or debt amount, and then the final debt amount is always the minimum. The banker's not going to take the maximum, it's going to take the lower amount that either results in a minimum debt to capital, minimum DSCR or maximum debt to capital. Right now that's zero because I haven't done that. And then I didn't do one thing. We have the debt applied, and I'm going to put the debt to capital applied. Sorry for not putting that. Now, for this part of the model, I've got to tell you, in the real world, when you have many debt issues, when you have maybe a change in DSCR, when you have some tax problems, the tax problems aren't that much, but the changing interest rates, this can get a lot more complicated. But this is the foundation, and it's so key to get this foundation and then go forward from that. So we take the final debt amount, and I'm going to divide this by the project cost and get the debt to capital. And this debt draws that we will have will apply this debt to capital against all the construction expenditures. So we'll take this amount. This is. I just realized this would give you a pro rata. Let's use the pro rata. No, let's not do it like that. Yes, I'm going to begin. Oh my God, I'm going to begin with that pro rata, but that little case made things a little more complicated. It said the debt is issued before the equity, if you remember that. For right now, I'm going to take the debt draws here and F4 and multiple. You notice I'm having trouble getting words out because I'm a little bit nervous. That's our debt draws. And then the big deal is to say, well, let's take the opening debt balance and make it equal to the closing debt balance. Once we do that, then we can put in the amount we're going to borrow of the debt, and then the debt repayments are the total debt service minus the interest. Okay, the debt service, we compute it up here, and it's very typical in these kind of exams to take this key line, this total debt service, and say you're going to use the DSCR to drive the pattern of the debt service. That's called sculpting. We're going to take that debt service and subtract the interest, because debt service is equal to interest plus repayment, and we go the other way around, and then I'm going to make this one a positive and this one a negative and get the closing balance. What we'll generally do is put a little underline, Shift Control E if you've got the generic macros open, and then we'll always use the opening balance on the debt and take the opening balance on the debt and multiply it by our periodic interest. So we've got all of the basically all of the formulas finished here, okay, with one big exception, and that's computing the value of the debt. Now, let's copy these, and I think I can copy them all the way. Okay, so now, we still have zero debt to capital, but this time we have some debt service coming in. I hope we do. And we don't, because I didn't copy I did something wrong here. Where's my EBITDA? There's the debt service. There's the CFADS, and I was supposed to take this CFAD. Sorry. Okay. I was supposed to take this CFADS. CFADS. I didn't put the flag in. Oh, of course, that's the most important thing. Good for that, because we need to talk about this. So in the input C this time, I was a little fancier. I said, here's the start of the repayment. The start of the repayment occurs right at the beginning of the commercial operation, and the end of the repayment, we just put 17 years after this and use that e-date function to get that finish of the debt repayment, and then we use an and function and say, well, let's look again always at this kind of thing, make it greater than or equal to this, press F4, and then go back up to that same date and make it less than this one, press the F4, F4, and you could have, done a fancier thing so you could copy this and later, which might have been a very good idea. Okay, and then we'll get a false. Then I'm going to press Shift Control B. All that does is it puts a little 1. It puts brackets around the whole thing, puts a little 1. That you could make that with an if statement. Most people in the world would make that with an if statement for some reason. And then we take 34 divided by 2, and that equals 17. So we've got the right number of flags. Now, once we have that flag in here, now we're all ready to go. And we take the CFADS divided by the debt service coverage ratio to get this. And then even though the CFADS goes a lot further, we stop the CFADS for computing the debt size, because that's the debt repayment will be over the kind of term. And then I do something crucial. And on this one, I take this formula and I put a little if statement. That's a wonderful little trick, in my opinion. And you start with this flag. If you do that, it'll get a false instead of a 0. And the false instead of the 0 is a wonderful thing, because when we compute the net present value at our interest rate of this number, we get a 26, and that gives us 98%. Oh, it's kind of like that other thing. Now, I'm sorry, I had to take a sip of coffee. It's become the morning. I'm going to just temporarily, to illustrate how this whole thing works, I'm going to put up here, let's put 200%. Let's be completely crazy. Of course, that's irrelevant. What that means is that the debt size comes from, down here, our final debt size comes from our debt service coverage ratio that we apply. And the fantastic news about all of this, if I can just show what happens. Now, there's another thing I should tell you, and that is that the first of all, let me tell you one other thing. This interest, let's not pay any of this interest, because you notice I called it interest expense, which is very, very different than interest during construction. The interest expense only begins after the project begins operation. So now what we have done is we've got this total debt size, which is the key thing. It's the net present value of all of the future cash flows of the debt service cash flows, and then we have some debt draws, and we have the opening balance of the debt. The opening balance of the debt has nothing, and then we look across, and then we start repaying, and then, oh, if this works, if this doesn't work, you've got a problem. And I can tell you, the first times I did it, it never worked. It was because I was very careful when we did the net present value formula, and we had a constant interest rate and some other things. Now, when you do this, let's put another couple of things here, lines, and I'm going to make sure that our closing balance, our closing balance test is a test such that this number right at the very end, this number right here in 31 December 42, and if we look at that 31 December 41 January, we can use 1 January 43. Let's make sure, I guess we can do it like this. This is pretty good. That's the kind of the day after. This opening balance better be zero in 1 January 43, which means the closing balance was okay. And then this just illustrates the lookup function. Look up, you go to this one, and if you had some class or some teacher that said VLOOKUP or HLOOKUP, please say, oh yes, Mr. Nice Man who taught me that, but I don't care about that because I'm going to use just the regular old lookup. So we just take that date, look up on the dates, and then look up on the years, and we use the whole row, and we've done it in a nice, lazy way, and we can put a test or something. I don't know what to really call this. Okay, and I can't, yeah, good. All right, and so then we have the balance. Now we've got some problems, okay? And now I can do this two ways. I believe I'm going to leave some of the interest during construction, the commitment fees, and also the taxes. Well, we can put some taxes in. Let's do the taxes a couple of different ways. Let's first just get the operating taxes, which is not the appropriate level of taxes. The actual taxes you would pay would be less. But for now, let's just use the operating taxes. And why I'm saying for now, with all of these things, and I'll put the taxes here on the EBIT. Okay, so now we have less CFADS. And what I had done here, just to make this a little bit kind of fancier, and again, you'd never get this last thing I just told you on the test. I said apply taxes in the CFADS. So this time, let's put this special case with no tax incentives to be true, because that's more like a typical project around the world. And this time, if we put a little flag over here, we can just lock it in, and then we've got taxes. So in this particular case, we've got taxes. Now the taxes lowered the CFADS. I think they did. I hope they did. They might not have. No, I didn't. Oh, excuse me. And coming up with a little test on that might have been a little bit difficult. I'm going to press Shift Control V, and I'm going to kind of make sure that they come down a little. We still have 90% debt to capital. So let's put our 85% back in here. That's percent eligible for the ITC, and we put this 200, and I'm going to put 85%. This time, this is completely the wrong way to do it in the real world. It's really the wrong way to do it in the real world. because the actual loan agreement will say the minimum debt service coverage. It won't say that you could have a higher debt service coverage. It will say you have a minimum. And now if we this time apply the debt to capital ratio from the project cost, we have this amount, which is smaller than this amount. And if we go across in our test, we've paid too much debt. And you go over here to the amount of debt, and it's too much. And there's a kind of classic thing that used to be a big formula that you take the minimum of our repayment that we computed or the opening balance. That's the little trick. It's not much of a trick. And then we've got our correct closing balance. And if you want to test it, you go here. And then we've truncated debt repayment. Our debt, our length of the debt is not the true length of the debt that was stated in the debt term sheet. Okay, so let's go all the way down. So if we put our sources of funds right now, we can put in the debt draws here. Okay, I'm actually going to take this from this amount. This is our debt draws, and our equity payable will always be the total minus the debt. Okay, and try to make it. I know it's asking a lot, but if you add that was alternate equal, and we tried to do things quickly, I'm pressing Shift Control V for my generic macros, and then we have one of the two cash flow statements. And if you remember, the very first comment I made when we started kind of the modeling was that you need one cash statement before the CFADS, and I mean one before and one after. Now I have to fix this thing I'll call the cash flow waterfall. We'll put less the taxes, and then we'll put CFADS. Now if, again, I didn't put a time pressure on myself, I did a lot of this beforehand. If you would have had a time constraint, please don't waste your time with some of the things I'm talking about. Please, I beg you, just try to get something done. Maybe just leave some tax stuff out and show you can do just a little bit on the taxes and here. So that's why this raised. This is what I raised. And again, this time let's go up and collect our EBITDA from here, and let's collect our taxes from here. Now this is a gigantic caveat, and I haven't put the circular references in yet, but the taxes applied to the CFADS the actual taxes will be different because they will be affected by the interest. And when the taxes are affected by the interest, you have that horrible circular reference. So let's subtract this. And this time, maybe I'm going to go and just get the interest this is going to be the interest expense. We have to be really careful because the interest during construction is modeled up in this section of the model. And then we can put the debt repayments in here. Okay, now this is, I would consider at this time, this is difficult kind of stuff we're doing. This is the subtotal minus this, minus that. Perhaps we'll make a little underline on the subtotal, Shift Control E in the generic macros if you don't have generic macros. And if I really think the generic macros might help you. Shift Control V for Victor, okay, and Control D, and then we've got all of this. Now I want all the formatting to be consistent, so we press Shift Control W, and we've got all of this stuff, and we got all the way down to the net cash flow. And this is really, if we have nothing else, this is called the dividends. Okay, and I put that underline. I'm going to press Shift Control G, okay, because that's such a big deal. The equity cash flow, now we really want just two different statistics from this whole thing. The equity cash flow is the dividends minus the amount of equity we put into the project. And it's negative up front, just like any cash flow is negative during the investment period. And then it goes positive after that. And then we can compute the equity IRR. Okay, and I'm wasting time by copying these little things here. I don't think you should waste time on that eventually. Oh, I can't do that. See, I just, oh God. My God, see, I just wasted incredible amount of time just now. How horrible. And I'm going to use XIRR again. We put XIRR, we select the whole area. And then once we selected the whole area, you take this. This is not easy. And now, look what we've got. We've got 13. It didn't increase it by that much. Now, if we would have put in the first case without, we got 15% because we have the tax incentives. I've got to be a little careful with this because we don't have the circular reference. Still, well, I know I have a problem. Oh shit, I have a problem. We on that capex. Do you remember we got the investment tax credit? We can put less the investment tax credits. So if you notice what I did, if you get a sense of this, because I said no, the taxes should have been much more. The issue is that we when we do our financing, if we have an investment tax credit, we get that money back, and the project cost, at least if it just would be one way to do it out of many ways to do it. So I'm a little bit reluctant to go into this too much, but we could have put our investment tax credit down here. And then I suppose this time I'm going to make it a negative number because I used the sum. Okay, so this time I hope that, we've got no tax incentives. I put the tax incentives, we get lower amount, we get a lower, actually we get a lower debt because we get that. There are all sorts of things you can do with the tax incentives, but now we get an equity IRR that's much higher. Excuse me for going through that really, really quickly. That would be more for kind of people who might be looking at these things in the US, and this investment tax credit is now changing because we've got a different political regime. So now I can put CFADS, and I can then below the CFADS put the debt service. And that debt service coverage ratio, I hope it's going to give us the one we targeted. So let's get the CFADS just from up here, and let's get the interest and the repayments. You don't have to do that. You could almost get that. Well, no, because we put that minimum, it would be better to do it this way. And then you put an if statement, and you go down to the debt service, make it greater than some really tiny number, 0.1. It's not that tiny. And then we'll divide the two, and what that gives us is a false if we haven't computed it. So we've got all the DSCRs, and it gives us the exact DSCR we started, which is what it was supposed to do. Okay, and we can put the minimum in here. Oops. And then I had argued and suggested when we had our little session, I had suggested, well, let's make a nice little graph of this, and the debt service coverage only occurs at the operating period. So I put a if the operating flag way up here, then we put the date, and it's the date is the end date because you pay the interest on the opening balance. Otherwise, you put NA and open the brackets. And then when you do that, press Shift Control 3 for making it the format as a date, and then you select the whole thing. Press F11 to make your little graph, and on this chart title, I'm going to put an equal sign and go and get our kind of case, and then we'll even take this little spinner box we made, copy that, and put that on our debt service chart. And you can see kind of that this debt service coverage ratio. And let me just do one little thing. Let's see if we can make it a little bit nicer with some longer bar, some wider bars. This wasn't really that much nicer, but if I go here and go to the border and make it a lot wider, that's my little trick here, then I can kind of see what's going on maybe a little bit better. That's not so great, so I'll let's make this a little bit. Oh God. Okay, that's even worse. I just wasted incredible amounts of time. Okay, and I just made it even worse. I'm going backwards. Okay, that's our green versus our blue. Enough of that. I can't see the two things enough. If you try to make it an area chart, you might be yelling at me. Why didn't you make this an area chart? If you make it an area chart and use this little NA function, sometimes it really doesn't work so well. And where's my chart? Maybe it didn't look like that, did it? Okay. Whoops. Damn. I meant to change the chart type and make this an area chart. And this one, maybe not so bad. Ugh. And I don't want it a stacked area. I wanted a regular area. Oh, and I just wasted a lot of time. The reason this goes up a little bit is we finished with the debt service. Actually, that didn't work out so badly, did it? And we show the debt service and the debt service coverage ratio and how long the debt is. And for some reason, this is because we truncated the debt in this case because we had such high cash flows because of ITCs. So we truncated the debt, blah, 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 blah. If I put this to the next case, not the P90 case, let's put the case without the funny taxes, then we get a different structure of the cash flow. We're sculpting the debt, and this is when the merchant cash flow comes about. So I'm trying to argue that this if you had to make one single graph, it would be this graph, and I almost want to put the IRR in the graph, but I'm going to stop. And then maybe if you had a summary page that they asked for, you put the IRR and the DSCR in here. So now we've got most of this done, except we could also, number one, we could do our valuation. Remember the case, they said, I'll do a valuation of this. Let's name this debt CFADS and DS. How's that? That's our graph. Let's kind of put this after the financial statements. Perhaps you could also graph this from the financial statements. Okay, enough of that. I'm going too long. For the project value, I'm not going to do it for now a third time. I'm going to do that. I'll put that in the final thing so that for the project value, we'll do the same sort of thing. We can take that cash flow line and put the buyer discount rate, and I'll do it like this. I'll copy this. Now, when I copy this, and remember the actual IRR for these private equity people will be exploding in some enormous amount. Okay, let's put that here. If you press Shift Control Plus, it will insert some lines. I'm going to do that again. I'm going to put this one lower. It will insert some lines, and I hope it will leave the lines we had before there somewhere. Perhaps I screwed up, but it should. You either cut or copy, and you just place it where you want and push the Shift Control Plus. This time, the craziness about this is they said take the buyer discount rate, and I guess I didn't do the regular old. I will do a valuation again. Remember let's just do the basic valuation. Okay, and what's going on here? If, excuse me, I need to put the tax incentives. If we put these tax incentives, we would be willing, in theory, so for we need to put a target IRR for the buyer. Okay, I promise not to waste your time with this, but I'm doing it. And then just to review it here, we could put a value for buyer without development fee. And that's really what they wanted in the whole case. And that was kind of intimidating for me at first. So we put X NPV, and we take this thing, and then we go to the equity cash flow. You just pick one of the cash flow lines. Do you notice how it's getting really repetitive? You take this amount, and this time, we can pay. This is the amount over and above. Now we're willing to pay $9 million. So this developer, remember, they paid $70,000, and they're getting $9 million, and that's exactly what they want. And then you could put cash flow with the development fee. And if they complained about that, I would tell them, oh my God, go take this one minus, I'm going up here, let's do it like this, a little bit more elegantly. Okay, so let's take this cash flow, and again, I'm cheating just a little bit. Plus, we'll go up here, F4 multiplied times this period right here equals 1. Just put that in a bracket just like that. Oops. And I should have put minus, because you have to pay the development fee if you're this private equity people. And then if you have to pay this enormous development fee relative to the cost of the project, now our IRR, equity IRR, will be the same kind of thing. So I hope this illustrates the valuation parts of the project, and we get back to our 8%. So that seemed to be the method that they wanted. Now, if we I'm gonna pause the video because we're such a long video. All right, let's go now and see what we can do to enhance the IRR with some refinancing. Now, to increase the IRR with the refinancing, or maybe not decrease it, the first thing is I put some inputs in. And these were tiny bit. This is refinancing date. So we make our mold very flexible, so we can put a different refinancing date here. I just put 36 months. Let's make it not so full. So let's make it only 24 months. Okay. And then we'll put a little flag, whether we want to do the refinancing or not. We can turn it on and off. I put a DSCR for the refinancing that was a little bit different than the original DSCR. That means we'll get more debt. If we get more debt, we'll be able to repay the original debt and get a big equity dividend for that. And then we'll put I put a little lower interest rate in here, and I said, let's put a tail. Now the tail, just so you get this defined, the tail is how much. So we're going to refinance all the way to year 2 here, or, we had one of these things. This was no tax incentives. So these, remember, all this little thing does is it just changes the scenario code. With a short life, that might be a typical looking our pattern of cash flow. So the tail would be, we're going to finance all the way out here. And you can think about this area in present value terms. That's the net present value of the debt service. That defines the debt. If you want to think about this, you think about a zero interest rate case. In a zero interest rate case, there's no interest. The debt service is equal to repayment. The sum of the repayment the sum is the same as the net PV with discount rate. I'm sorry I don't have the picture on right now. Maybe I should have switched the picture on. Can I do that? I can't do that anymore. Okay, good. I was trying to explain it with my hands, and that was kind of silly. All right, so let's go to our financial model, and let's get the refinancing configured. Now, again, I'm doing all of this so far with no interest during construction and no fees. So I didn't put any fees on the refinancing, which would be easy. But kind of like we have done up here when we did this debt structuring, and I should have called this debt structuring for the initial debt. Let's do the same sort of debt structuring for the refinance debt. So I'm going to just add some lines right here. And the reason I'm saying this is when I started this whole video, we looked up some of those cases, and there'll be a number of cases, not a great number, but a number which ask for refinancing. Now that's advanced, but if you can do the refinancing, and it's not that advanced actually, what we'll do, you can almost take the same sort of titles here. We don't need all this other crap here, but we need to do this sort of thing, kind of stop here, because the refinancing, we don't use debt to capital anymore. That's ancient history. We've got actual cash flows. So we could take, I don't really have to do this, but I'm going to, and I'm going to just take these same lines. Let's start with those. Perhaps that was a little waste, but no, it didn't take very long, did it? And then we put our debt repayment flag. And the debt repayment flag is, you notice I didn't bother with the dates. The debt repayment flag, we start with the refinancing date and we finish with the final amount. Now, before we do that, there are two, and I did that a little bit incorrectly, and I'm sorry about this. We'll put this refinancing date here, and that's an extremely important flag if you're going to do some refinancing. We'll put that there. And then our repayment, we'll put let's put E date, and let's take this date that we begin with. And I think all the dates will be okay. Will be January, July or something. And let's take and increment that by 6 months, or if we want to be a little fancy, increment it like that. And then we have our refinancing term. And then we'll multiply this. So let's just put this flag in because it's so important. Put an equal sign. It's all going to be issued at one single period of time. We don't have to. Whoops! Oh shoot! It's this thing equals this thing. Okay, and then on this we put and again and this, and you should just be able to start doing this really quickly. Or you can you can press F4s and kind of have a nice little and thing that you repeat. Okay, and then we'll press Shift Control V and Shift Control R. So what we have up here is a refinancing flag, and we start the repayment after the refinancing flag. And this gives us the number of periods of refinancing, which depends on the kind of the tail. And then we get our CFADS for refinancing, which we'll just take that's during this refinance, this repayment period here. But remember, we'll put an if statement, and we'll use it with an if statement, not a multiply. So we'll leave the false in. This is kind of a different one. Let's put the target DSCR in, okay? And after we put the target DSCR in, we can just put, we can just take that and copy it. And then let's put the target debt service. I'm going to use another if statement. If it's this flag, then we take this divided by this, okay? And then let's put the interest rate. And the interest rate, remember, we have to adjust for. So it's all just very repetitive. We'll take this one, lock this one, divide it by the 12 periods if it's the construction, which it won't be, or the 6 periods. And then we put our finally, we get the amount of money we can get from refinancing, which will be the NPV. Why don't I copy these first? And then after I copy these, let's get the XNPV, and again, I'm going to do it like this. I made a mistake just now, okay? And we'll put not XNPV, just regular NPV of the using this interest rate, and I should have divided by 2, not divided it by 6. Okay, we'll take it of this line. So at least I see divided by 12 multiplied by 6. Okay, if you can get used to that kind of stuff, then let's do the same sort of thing, and let's make sure that we have some. There's a little bit of stuff going on in there. Okay, let's do the same thing and make absolutely sure that our opening balance and our closing balance go down to 0. Anybody's still here, I should ask you, if you're still here, I should give you a prize, but I don't have many good prizes. I should give you a little badge that says, what could we put on this badge? Monica Lewinsky badge or something like that. No, she was okay. Poor Monica. Then we'll put this here, and this time our debt draws are this amount, which is the amount of the thing, but we take those debt draws and we lock them and we multiply those things by our little flag that we add for the date of the refinancing. And then we do exactly the same thing. So we took the target debt service minus the interest that I didn't put here yet. And let's go down here and put the interest. Okay, and this is always, there's no more, interest during construction or anything like that. So let's take our opening balance and multiply that by the interest rate, which is right here. So we've got all of the stuff together. Shift, Control, W maybe, and let's put the closing balance as the opening balance plus the amount we borrowed minus the amount we repay, blah, 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 blah. And then we can press Shift, Control, R, and then we can say, oh my gosh, and I should be hiding this. I think I'm making a video. I hope I'm still recording. Yes. Okay. I just want to hide that. Excuse me for that. So we have our big debt issue, and of course we need to put our little underline. If we didn't put our underline, we'd get in big trouble. And then we get down to 0. And 0 occurs hopefully in right before 1 January 2024, and we've got our total refinancing finished here, and that's it. So that was a good little review, perhaps, of the regular old refinancing. And then now this is kind of like a source. We don't really need another source and use statement, but down here, when we're getting to the interest, what we'll do is now we'll put the interest on the original, and we'll put the repayment on the original. And to do that, we will, and I'm thinking about that refinancing flag, which I'm not going to bother with now, because the other way to get rid of this one is just to put a refinancing date after the whole project is finished, and then we don't have to do that. And right now, perhaps I'm going to put, let's put flag before refinancing. Now, I have to admit something. I've never done it like this, and I'm going to go to this one and put flag after refinancing. And all we do here, okay, and I'm not going to do the thingamajig, and I'm going to put the flag before refinancing as not this period, not the debt repayment flag for the refinancing. So that's true. I'm going to leave it true just for once. And I'm going to put this one, that will be the flag after the refinancing. I'm going to kind of put not this one, which will give us the original one back. But using not for me is a really big deal. So this time we'll take this amount we had and multiply it only by the pre-refinancing, and this one only by the pre-refinancing. And then what we've got to do is up here we've got to put a little bit, says the repayment of original debt. Now maybe somebody's got a better way to do this. Could be. This is the way I do it. I can't even, I'm wasting time on that. This time, we're going to repay the debt at the end of the period. So we have this wonderful little flag we have for the refinancing date. And we're going to multiply that, and I hope I just took the right amount. And we're going to take how much debt was at the end of the period. We've got a little closing balance, and that's how much we're going to repay. Let me just make sure I didn't make some silly thing here. So this was all true, and then we went to, so this was the end of the refinancing. That's going to be a negative cash flow. So we can go down here and put less payment for repayment of original debts. Okay, now before we do this, can I just, oh no, I can't do this. I screwed this up. I can't remember what the equity IRR was without the refinancing, but let's leave it anyway. So we put the repayment of the original debt up here, but that's a negative number, so we put a minus on that one. And then, so that one, we've paid that. Why is that equal to is that equal to the sum of the repayments? And then we'll put add the new refinancing, new debt. But we, of course, got to pay off this new debt. So we're going to have to put less the repayments from the refinancing. Now, the first times I see how some people do it, and they make it so complicated, it's ridiculous. So we'll just take this flag, we've got this flag, and we're just going to go up, and we really don't even need that flag, but it's maybe a good little practice. We've got the repayments up here. Okay, Shift Control V for Victor, Shift Control V, I'm getting nervous. And then we'll put less the repayments this is the interest, excuse me, less the interest for the refinancing. And we'll put that down here, and we don't really need that. So why did I make a little bit of extra work when I didn't have to? So we'll put that here, okay? And did I take this one? 226 times 203. The interest, of course, I did incorrectly. The interest was at the bottom. Napoleon said, "Dress me slowly because I'm in a hurry. I should listen to him." And then we'll put the once we have that refinancing here, let's put the new debt issued that we get to put into our pocket, and that's the big deal. That's the thing that overwhelms anything else, because we've got this new big debt draw, and that debt draw we have is a lot bigger than the debt repayment we had. And then we'll copy this, and now I've got one more kind of thing to do, and I'm going to have to pause the video for just a minute because my favorite person just came down for breakfast. All right, let's put the cash flow. Why don't I put the cash flow when it's a negative amount? Let's make it a negative amount. That means it's cash outflow, and that's kind of a classic cash flow statement. And this one I've already got as a negative amount, but here the new debt is a positive amount. So now we can simply make a sum from the CFADS all the way down. And once we get this sum, we can then take the equity cash flow as this versus this, and suddenly, oh my God, okay, I get this enormous positive cash flow. Now let's just make sure that I didn't make some silly mistakes. And I did, because the repayments on the original debt should have been here, and I put the repayments incorrectly. Why it's doing this? Just a minute. All right, so I had some signs incorrect, and I suppose it was a very good idea, really, when you look at this, to put the repayments on the initial debt, the repayments on the second debt. We're repaying the first debt, but the whole big deal is we've got this enormous cash flow, and then we get this really, really high IRR. Now, if we had changed this a bit, let's say that our refinancing date is 48 months later, not that, and let's say that our DSCR remains at 1.2, which is not bad. But the big deal is, let's say the tail has to be 5 years because we had all that merchant risk at the end. And then we put this in, and now our equity IRR is a little more reasonable. Finally, just before I go down to the, I've got negative debt service, I better put that in here. So if we put this one, we reverse the signs. This is our debt service on our first facility, and now we still have the 1.2, and now it's kind of finished. But now we can illustrate how this works with the second facility. Now, when I do this, when we have to, we'll put debt service original, and then debt service on the refinanced, and this time I'm going to put a negative, and we'll just go upstairs, and we almost always get all of our data from the cash flow waterfall. This time I'm going to change this CFADS and put
what we really want to do this time is put the, and we've got to be a little bit careful. I'm going to put the dividends, but I'm going to put that dividends as just the dividends without our special cash flow. So our dividends, I'm gonna take our final dividends and then add back the dividends that occurred on that special refinancing period. So I put all of these in, and then I think they're kind of smooth. Good. And now I'm going to make one more little graph, and I need to not show the X scale, because what we're going to do is show a graph and make it a stacked bar graph. So I'm going to press F11 to make our little graph. Oof. And I got that wrong in the 1 year. And I'm Alt EL, I'm going to delete that. First, I'm going to press Shift Control 3, and then I'm going to pause the video for 1 second so you don't have to show. All right, I just fixed the dividend. So now what we do is we don't show the CFADS, but we show the dividends, and when we add up all of these things, they basically add up to the cash flow, except for that very special period. And let's go back to our case with the add kind of no tax incentives, because it was the smoothest case. We press F11 and it shows kind of the refinancing and everything else. I might have a little bit of a problem. I'm going to go to the chart design and change the chart type and make it a area chart, and I can kind of see what happened. I've got to work on this, what happened right at the end, and so you can see this we could kind of work on, and I'm gonna go ahead and fix this. Excuse me for saying this, but I'm going to finish the video, and this in the next video, I'm finishing this now. In the next video, I'm going to show you the circular reference and also fix this little thing. And we'll also put all the financial statements together. We're going to do these 3 statement financial statements and all that stuff, and we'll use a little sum if and so forth. I need to stop it now because I have to go catch an airplane.